We're joined from Washington by Fred Bergsten. He's director of the Peterson Institute for International Economics. He's also a former Assistant Secretary for International Affairs and former Undersecretary for Monetary Affairs at Treasury during the Carter and Reagan administrations. Mr. Bergsten, welcome to Bottom Line. Thanks so much for joining us once again.
Good to be here.
Sir, as my colleague Michael McKee usually does, he succinctly and directly came to the point. What happens to the debt deal for Europe if the Papandreou government falls?
Well, I'm not sure your colleague has all the facts right. There is a lot of confusion coming from Athens, but my understanding is that the opposition party earlier today said they would support the debt deal. Now, if that's correct, that I think clears a huge hurdle in Greek acceptance of the program, and it would open the door to implementing the arrangement that the Europeans worked out last week. It would leave open whether Papandreou stayed prime minister, whether the opposition took over the government, or whether they had a coalition government, which would be the best outcome. It does look like the referendum idea is off. That's a good thing. And my impression is that they are headed toward a more unified political base to accept the conditions, work with the European lenders, and therefore proceed. So I actually view what's happened today as good news on the European front.
But Mr. Bergsten, as Michael correctly pointed out, the opposition leader did lead his colleagues out of the parliament today, and he called on Prime Minister Papandreou to step down. Even just mentioning that in a parliamentary session, what does that do to the political give and take and what we're seeing now going on in Greece and throughout the Eurozone?
Well, I'm not sure how much difference it makes if the opposition party supports the deal. They may be trying to lever that into a takeover of power, in which case Papandreou and his PASOK party would have to then support what the new government was doing, because after all, they negotiated the deal. You'd still wind up with a unity government, a coalition government, in which the two big parties were in support of the agreement. From the standpoint of implementing the agreement, I'm not sure how much difference it makes which party is in control, as long as both of them are in support. Maybe a new government might, in fact, even have more leverage and more support within the Greek population, since they were not as much at fault for having done the deal. But to me, the key thing is whether they both agree, and it looked to me like that's where they're headed.
But Mr. Samaras is quoted as saying today that he wants to change the nature of failed measures. How do you do that without, in the opinion of some, changing the government?
Right, and that's presumably his argument. But the question, again, I keep coming back, is whether they try to change the terms of the bailout deal with the Europeans and the IMF. The Europeans and the IMF have made it very clear that it's not up for renegotiation. So when the opposition party has been campaigning against Papandreou on the grounds that they would negotiate a better deal, that's just false. The other side of the deal would not renegotiate. So now the opposition, I think, has chosen an alternative strategy, say they agree the deal, but try to use that to force Papandreou out and take over, but still have a unity government, only with them at the head of it. But I think the bottom line, if that's right, is a unity government in Greece, no significant change in the terms of the deal, which means it can then go forward, and everything that was worked out last week, too much fanfare and applause, rightly so around the world, can go forward. So again, on that scenario, I think the outcome is quite positive.
Mr. Bergsten, the European Central Bank did make a surprise decision to cut interest rates by 1/4 percentage point to 1.25%. The move comes at Mario Draghi's first meeting as the new head of the ECB. Will the rate cut help, and what does the action tell us about Mr. Draghi's leadership just 48 hours into his new job?
Very positive on both fronts. I think it's courageous for Mario Draghi to have done this in his first meeting. It's clearly needed in light of the downgrading of the outlook for the European economy. I hope and expect that it's only the first of a series of moves. The European Central Bank had raised interest rates twice earlier this year. This only reverses the last of those. I think the European Central Bank needs to cut its rates by at least 100 basis points. Today they only did 25. So I hope it's only the first in a series of 3 or 4 steps. If they do that, it will clearly help the European recovery. But the European recovery needs more. Germany and the other strong countries in the core, the northern part of Europe, need to reverse course on fiscal policy.
Right.
Those countries are still tightening fiscal policy. They need to at least stop the tightening, hopefully go into reverse, provide some stimulus. The Germans, in short, need to buy more Greek products instead of writing more checks to the Greeks. That will help on the real side. There are two parts of the European crisis: financial engineering, real economic expansion.
Okay.
They're doing a tremendous amount of financial engineering. I think that's on track. They need to strengthen the real economy. What Draghi did today helps a lot, but he needs to do more, and the Germans need to do more as well.
Mr. Bergsten, we have about a minute left. Is a breakup of Europe's common currency, the euro, now a real possibility? And will that take up much of the discussion at the G20 summit in Cannes?
No and no. I do not think the breakup of the euro is even a remote possibility. The worst case from the euro standpoint is that Greece would default, would break up the current bailout agreement, and would essentially be kicked out, not just of the euro, but of the European Union as a group. But that would not hurt the euro. It's only 3% of the economy, and a Greek exit would not even dent the euro. The question is whether it would spill over and promote similar exits or thoughts thereof on the part of the bigger countries, particularly Italy and Spain. I think the result would be the opposite. If Greece were to exit, I think the effect on them would be so disastrous, so traumatic, that the demonstration effect for the other troubled countries, including Italy in particular, would galvanize them to do everything they could to avoid a similar fate and comply with the programs that have been forced upon them. So I don't think there's any risk for the future of the euro, and I think the G20 would be wasting valuable time even to discuss it.
Fred Bergsten, director of the Peterson Institute for International Economics, joining us from Washington. Mr. Bergsten, it's always a pleasure. Thanks so much for joining us today.
Good to talk.